Good afternoon, ladies and gentlemen. Welcome to today's presentation for the radioactive trading techniques following our journey into the limited risk trading techniques. Today we're going to discuss, of course, is it time for an income method? We're going to look into the next steps of a radioactive trade. What we do, of course, after we open the position, what our plans are, of course, and why are there 12 different income methods that we discuss through the different webinars. Again, for those of you who don't know me, my name is Mike Shupka. I'm the Director of Education here at PowerOptions. And again, welcome. Now, during the past 2 weeks, during this month, we've been sharing with you the benefits of limiting risk just in time. Whatever happened yesterday, reaction from the Fed announcement, is it an overreaction? Is it an underreaction? Time will tell. But just looking for December itself, well, to quote Bill Murray from Scrooged, my God, did that suck. Now, many of you, of course, were probably in bearish positions. Hopefully, many of you started to protect your positions after you saw some of our webinars about using the proper put to ensure your stock positions or opening a new position having controlled risk in place. Now, of course, sorry, folks, just to review. Rather than go with a cheap, out-of-the-money, short-term, near-term put option, which will increase your annualized cost and still take on double-digit risks on a position. The structure we start off with, we put time on our side. We control risk properly by just going slightly in the money and further out in time. This not only gives us a lower annualized cost for the insurance policy on our position, it not only gives us multiple months to do other trades inside that protected structure to lower the risk and potentially cancel the risk long term. It also gives us the proper way to use that initial insurance, the initial put, as the second asset. So we're not going to just wait and expect the stock to go up. Well, we are going to wait, but we're not just going to close our eyes, wait for the stock to go up. We're not going to leave the position alone and then come 2 days before expiration, 3 days before expiration, go ahead and say, well, where do we stand and what can I do now? Are we going to sell the stock when it's up, or are we going to sell the put when it's down and just kind of go in and go out and go back and forth, buy back in, buy back out? Not quite. After the initial structure is placed, we teach 12 different adjustments that can be used inside of that structure. Of course, just like any trading plan, what is the goal of these 12 income methods against the initial structure? Well, naturally, it's to generate income, just as you might be doing now with different strategies in your portfolio, but inside a nested, protected position where we don't add to the initial at risk. The income methods are going to help us lower the risk, maybe lower the cost basis on the trade to help us increase the profits longer term. And, of course, these are designed to help us bulletproof the position. And bulletproof means a no-risk trade. Is it possible to have a no-risk trade? In the proper structure, yes, it is. The desired outcome is to meet our trading goals. But we also want to take a low-risk trade to potentially a no-risk trade. With the proper structure, we know right away we have a known single-digit risk. And a lot of strategies, you might have a known risk, doesn't necessarily mean it's single digits, and even if it is, it doesn't mean it's the proper structure. Using these adjustments, we're going to lower that risk and then eventually enter a position where we have an insurance policy still on our stock, still it may be in that nested trade, where the insurance policy is a higher price than our total cost basis in the position. And that means that it's bulletproof. So why are there 12? Well, the last 3 months, the last 12 months has taught us anything. It's for different market conditions. Some of the 12 income methods are best used when the stock moves up in price, which was our initial expectation. Some of the adjustments are used if the stock is stagnating. Some are used if the stock falls, but you think it's going to recover. And then there's some that allow you to profit in both directions. Right? But before we go any further, let's just take a quick gauge of where everyone stands that's joining us today. And first off, I want to know, what is your main strategy that you used over the last 12 months? Were you mainly focused on stock only? You weren't using any options as hedges or protection? Were you looking at covered calls, naked puts, sort of parity trades of one another, and in the money covered calls a parity trade to an out of the money naked put? But of course, some of you who are more bullish might have been using out of the money covered calls or holding a stock long term and just selling out of the money covered calls to generate an extra income and leave the upside a little bit more open. Not open, but a little bit more. Vertical spreads, credit spreads, debit spreads, iron condors, those types of strategies. Were you buying calls and buying puts? Going into a security with a call, if it went up, sell half the calls, maybe buy puts, doing straddles or so forth. Or were you potentially looking at calendars, diagonal spreads, horizontals, or perhaps ratio spreads as well? Now I'm going to leave the poll open for about a minute or so. Okay, we've got a fair amount of our audience voting in the poll so far. I'm just going to leave it open a little bit more. Okay, there we go. Okay, some more votes are still coming in. All right, so I've had the poll open for about a minute and a half. I don't want to take up too much time. Still some votes coming in here. Okay, let's go ahead and close, some more coming in, but let's go ahead and close the poll. I'm going to share the results with everyone. About 60%, a little bit more than 60% of you voted. Okay, that's great. So 9% of you were doing stock only, not using options at all. 27% of you were doing covered calls, naked puts, out of the money naked puts, cash secured puts. Winner today, of course, 55% of you were doing the credit spreads, debit spreads, iron condors. No one was using long calls as their main strategy, buying calls or buying puts or straddles as their main strategy. That's good. I'm sure some of you were doing that. I do it with about 10 or 15% of my portfolio. And 9% of you are doing calendars or the ratio spreads. Fantastic. Very quick follow-up poll. And the last poll I'm going to have for a while, of course. How did that work out for you over the last 12 months? Was it great? Was it the best return that you've seen in maybe the last few years? Were your trading results good? You hit your target goals for your yearly returns? Were you at about a break even? Maybe a little bit more, maybe a little bit less than you started off with? Was it not good? Did you have some gains and then maybe gave that all back in the last 3 months or maybe even in the first 3 months of the year? Or did you have did you have terrible results where you're way down for 2018, the last 12 months, possibly erasing gains from what worked for you in 2016 and 2017 going forward? Okay, so I've had the poll open for about a minute or so. Let's go ahead and close the poll there, and I'll share the results with everyone. Okay, so 18% of you said that you had a good year, that you met your expectations. That's fantastic. No one said they had a great year. 45% of you were at break even, maybe a little bit better, maybe a little bit worse. 36% of you were in the not good range. You had some gains, but then gave them back to the market with the last conditions we've seen in the last few months. Thankfully, no one said that they had a terrible year. I believe it was around 8 or 10% during the first presentation we had a couple weeks ago, about 2 weeks ago. Okay, fantastic. Let's go ahead and hide that and get back to it. So why are there 12? Well, it's for different market conditions, but why are there only 12? Well, everyone wants to improve an idea, or everyone knows better, and there's nothing wrong with that. We're always researching, we're always analyzing, we're always trying to improve our trading results going forward. So we see a lot of questions that come in, we see a lot of comments. So You might know better. You say, hey Mike, I saw your webinar on married puts. I saw the position you opened on Tuesday with NRG. I entered that, but I entered with it a bull put credit spread. That's one of the 12 income methods, right? Yeah, I don't own the blueprint. I'm just assuming this is one of the 12. Bullish on the stock is why you entered a married put, so I'm going to enter a short-term bull put. That's got to be one of the income methods. Well, it's not. And it might work, but there's a specific reason why that simple structure of a bull put credit spread is not one of the 12 income methods. The roles of the income methods after we set up the initial structure is to generate income. A bull put credit spread would do that. I sell an out of the money put, buy a further out of the money put, I take in a net credit, it lowers the total cost basis of the 4 legs I have. Stock, insured with the put, and now I've got this out of the money bull put spread. Lower the risk in the cost basis on the trade. Well, if I generate credit, that's going to lower the cost basis. Sure. But it increases the risk on the position, and it potentially can increase the cost basis as well if not managed correctly. And we talk about the bulletproofing aspect. Would a bull put credit spread help us get to bulletproof? Well, it could over time, but each time you do it, you're taking that chance of increasing the risk. What did we do on Tuesday? Well, we talked about the criteria that we use for opening a new radioactive trade. We opened a new radioactive trade after we found it on the RPM report and the PowerOptions tools. We bought 100 shares of NRG at $41.35. Following the proper structure, we also bought a January 2020 45 strike put in the money, far out in time, proper structure for $6.90. This does make my total investment $48.25. But at any time over, I think it was the next 395 days, we have a guaranteed exit of 45. So worst case scenario, the absolute worst we could do is to lose 325 or 6.7% of what was invested into the position. Here's the profit and loss chart for the NRG position, shown using the PowerOptions tools. Of course, highlighted, we see today it's at 39.34. I actually believe right before the webinar started, it moved a little lower and was trading at 38.98. I guess we can blame the Fed for that, or we can just blame whatever we want to. So it's down about 5%, maybe a little bit more. Now, two things very quick. The max risk is 325. That occurs if and only if I hold the position all the way to expiration, all the way to January 2020, did nothing between now and 395 days from now, and accepted no dividends if NRG pays a dividend. Because of the proper structure, the time value of the put is still very high. We still have 393 days of time value on that put, and we've gained some intrinsic value to counter the loss on the stock. Right now, I'm only at about a 1.8% loss, not favorable. But think about it this way. Had I bought NRG at 41.35 and bought a 04 January, 15 days out, 17 days out on Tuesday, but 15 days out from now, 2-week output for 48 cents at the 40 strike, 50 cents at the 40 strike, I'd still have a risk of about 5%. The stock needed to fall $1.35 before the insurance kicked in. I paid 60, 70, 80 cents for it, and right now today I'm at maximum loss. Because of the proper structure, I'm at a much lower loss because I put time on my side. Now on Tuesday, I could have considered a bull put credit spread. It might be one of the income methods. It might be one of my favorite strategies. 55% of you are doing vertical spreads. So on Tuesday, I could have opened a bull put by selling the 04 January, about 15 days out, 40 put for 65 cents. Buy a cheaper out of the money put to give a little protection, the 04 January 38 for 25 cents. this would have generated a net credit of 40 cents. About 1/8 of the total risk of 325 we had for the married put. So the new at risk should drop down to 285, right? By itself. And we can see where it stands right now. This bull put spread on NRG was a 25% potential return if NRG stayed above 40 in the next 15 days. Had a probability of about 68%. I know we'd probably take a higher probability, but hey, we were bullish on the stock. But it carries a margin of 2 points, or a true risk of $1.60 on the position. Side note, real quick, I have had 8 calls this week alone. My bull spread is losing. Bull put credit, bull call debit. How do I fix it? Most of these positions, because the drop we saw in December, were already below both strike prices and had only 3 to 4 days to go to expiration. There's not a magical fix for something in that situation. You could close the position and roll the bull put down to try to take back the loss, try to generate a credit of $1.60, but to do that, what do you have to do? You have to go 2 months, 3 months out in time. And I can't use a 2-point spread that I started off with. I might have to go to a 5 or even a 10-point spread in order to get a credit close to the loss I took. Because these bullish spreads, of course, come with that 8-to-1, 10-to-1 risk-reward ratio. Excuse me. So what does that tell me? Well, it tells me that not many watch that video I did on the 8 ways to manage a bull put credit spread, where we talk about the trigger points to roll a bull spread before it gets into too much trouble and the preferred ways to manage it. It also tells me that we love to focus on the returns and risk be damned until the risk is an issue. Now let's take that bull put and let's take the married put we did open and let's combine them together. This is the profit and loss chart of our married put combined with the potential bull put credit spread, which is not one of the 12 different income methods. Did it solve the rolls properly? Well, we generated income, so we lowered the cost basis. That's true. But the risk increases from 6.7 to 10%. I don't want to be in that double-digit risk zone. That starts to put me down that slippery slope of gambler's ruin in the martingale. Why did the risk increase? Because if the stock falls, I'm still losing on the married put structure, but now I have a bull put that's losing additional money against the position. Could I use this to bulletproof it? Well, if I get 40 cents, and I started off with a risk of 320, if I'm right, over 4 or 5 months, if I'm using bull puts that are 14, 15 days out, or if I use the full month, it might take me 8 months. So it could potentially bulletproof in 8 months. Now, that's a long time to wait. There are better adjustments to use and better positions. But of course, where would we be now? Well, NRG is at 39.42-ish. It's still dropping. With 15 days to expiration, just opened the bull put 2 days ago, it's going to cost me $1.30. It's more right now because right before the webinar, NRG was down to 38.98 or so. But in any case, it cost me $1.30 to buy to close the 40 put, and I'd get 50 cents back for selling to close the 38. Well, liquidation is at 2 times the net credit. It's going the wrong direction. I'm adding to my risk on this position. Another risk is that I could be put the stock early. Someone panics on the other side, exercises those 40 puts, I end up buying another 100 or 200 shares of NRG that's now not protected. My initial shares were, but the new shares I was just put weren't. And if it's still trading around $39, $38.98, the 38 put is just sitting there. I can't use that. I can't exercise it. I can sell to close it, but that's another risk of doing it in the structure. So that is not one of the 12. And I'm using this to highlight the idea that there are proper ways to structure the position. There are proper income methods to use. Of course, that's probably why you're here today as well. There are riskless spread trades that are used. Income method number 6 is a bear call credit spread, done in the proper structure, but it doesn't add any risk and it leaves the upside open. Ratio call spreads are used inside, but we don't take the infinite risk that you normally would take with a ratio call spread. Broken wing butterflies and even condors are used inside this married put structure, the radioactive trade, to help us get to that lower risk and potentially bulletproof status. Many of the income methods are strategies you're already using, and a few of them are obvious. The bull put is not one of them. And I get that question a lot. That's why we started off this way. But the first and most obvious one, of course, is just income method number one. And you've already figured out. Say, hey, Mike, if you had just sold a call on NRG right away when you opened the position on Tuesday, you could have reduced the risk and you could have bought it back cheaply today. And you know what? You're absolutely right. Selling a call to create a collar, but using a shorter term call, of course, to maximize our annualized premium is income method number one. But I don't want to do it the wrong way. And there are many ways that I could do income method number one incorrectly and actually hurt the position. But we see a structure that has a known risk and a limited risk. That bull put had a known risk. By itself, the bull put we saw in NRG had a known risk of $1.60. But that was about 7 times the initial net credit that we received. So it's a known risk, but percentage-wise against the position, it's a 7-to-1, 8-to-1, 9-to-1 risk-reward ratio. With the married put, I have a known risk that's only single digits of what I invested, and I start off with infinite upside as well. It's a better structure long-term. But looking at what we did on Tuesday, and looking at what was available 30 days out in time, here's our historical chain from December 18th. The stock had dropped a little bit towards the end of the day. We see it at $40.89, about 50 cents off from where I purchased the stock during the Tuesday webinar. Good premium, about a third of our maximum risk of $325. I could have sold the standard expiration January 2019, January 18th, but 2019, 42 call for $1.05. This would have given us 32% against the initial risk of $325, and that's good. Okay, so we have our structure. We sell to open that January 42 call for $105. We take in income. We lower the cost basis. What in the world is with this risk? How did the risk almost double? Not quite, but how did the risk go up from 6.7% to 11%? Well, it's because this income method was done incorrectly, meaning that I still have a cost basis of $47.20 for the stock plus the put, minus the call premium. But I've agreed to give up my shares of stock at 42 if this weakness recovers. I'm not saying I know it's going to, but I'm saying I originally purchased this position with the expectation the stock was going to move up. If the market snaps back, if the market recovers, and NRG starts to move up in price, what's happening? Well, I've given myself 2 ways to lose. I now have an upper and a lower break-even on a stock that I was bullish on to begin with. And if the stock's right at the peak, I could make 2.3% on the position for the first 30 days. I'm generating a good premium, I'm not getting that wrong, but the only way that this adjustment makes sense is if the stock is trading plus or minus maybe 1% from the short call strike price at 42. Now, that poses another problem, doesn't it? Meaning that when I initially opened the married put position, as we saw on Tuesday, using the selection process, 7 out of my last 8 trades, 88%, met or exceeded the goals of moving up 3 to 6% in the first 20 days. That would put NRG at 43.20. That's about halfway, about 4.5% by about January 18th. With the RPM by itself, what we structured, if it moved up to 43.20, in the first 20 days on about January 8th or so. Right, we opened it on the 18th, so we take 10 days to the 28th and then another 10 days to the 8th of January. The put is going to lose value, as the stock moves up. That's true. But done in the proper structure, I still have a gain on the position. Might not have met my trading goals yet, but think about it this way. If the stock's at 43.20 on January 8th, I might be able to get 70 or 80 cents for the 45 put in January, putting me in a much better situation. I could probably get $1.20, $1.15 for the February 45 strike call. Again, putting me in a much better situation where I wouldn't have two ways to lose because it was done properly, and I still would have reduced the risk by that 30%, one-third of the initial risk involved. Because the structure puts us in a positive delta position. And if that's my trading goals, and I'm right about 88% of the time over the last year's trades of meeting that goal, why would I want to cap the gain right away just to potentially hedge the risk? You sell that call too soon, and at too low of a strike price, you actually create a bearish position, not a bullish position that you researched. With income method number one, had I opened the short call right away on January 8th, what would we expect? Well, if the stock moved up, if it recovers and hits that target range of 3 to 6% in 20 days, I'm going to see a smaller gain of only 15 cents. Why? Because that 42 call is now $1.20 in the money, plus it still has 14 days of time remaining on the position. It would cost me roughly $1.60 to buy it back, to leave the upside open to stay in the position. I only collected $1.05, so again, I'm moving in the wrong direction. I put myself in a position counter to my original expectation. I increased the risk potentially to the upside if the market recovers and it turns out I was right. Gave myself two ways to lose. That's not the proper structure. This is why we wait. Now, I could have done something right away that generated income and left the upside open, but it would still be in a loss range with the expectations. There are do's and don'ts for each income method, what we call the CEGA model. You evaluate what are the current conditions, what are my expectations, and of course, what are my goals, and that determines the action. Now, I know all of you know how to sell a call. I know all of you are familiar with covered calls and the risks of covered calls if the stock doesn't move in the direction. And when the stock doesn't move in the direction, what do? Well, you buy back your call for an increase in premium. You sell a lower strike call to kind of hedge the loss you're taking on the stock. But if the stock recovers, now you might be locked into a loss. You've got one or two ways to maybe manage the covered call long-term in that structure. But this is a complete structure. And inside this complete structure, if you sell the call too soon at the wrong strike price, you can get into trouble. When I'm using just income method number one, I want an income that is at least 1/3 of the maximum risk. If you're using weekly options, and you can use weekly options in this structure, but I'd say that you maybe want to cancel 1/5 to 1/4 of the risk if you're using a weekly option. The short call that you're selling should always be at or above the put strike price, so you don't put yourself in a bearish position on a bullish stock. And I never want to increase my risk in the direction that I thought the stock was going to go. Okay? Would I ever use an income method right away? Well, as I mentioned, I could have done one thing that generated premium and left the upside open. I could have structured NRG to profit in either direction at the start potentially, but it would have increased the cost basis and increased the risk, almost doubling it. I could have sold that call right away, and right now, both adjustments of trying to profit in both directions from the open or selling the call would be favorable. If I had sold that 42 strike call on Tuesday, not following the rules in the blueprint, going in too soon, going against my expectations, sure, I could have got $1.05 and I could buy it back today for about 40 cents. It looks favorable. but we're only 2 days in the trade. The market could snap back, and both would be at a loss, both of these ideas, of what I could have done right away, to profit in either direction or to sell the call to generate premium right away. If the market recovers and hits my expectations in the first 20 to 30 days, both those structures would be at a loss in the first month. Okay, but I promised an adjustment. I'm going to go to Power Options now. We're going to look live at where our two recent radioactive trades stand, NRG and the SBUX position from about 35 days ago. Why do I not have slides prepared for it? Because I don't know what I'm going to do yet. I'm going to look at the market live. I'm going to use the Power Options tools to show me and to help me specifically find what adjustments I might make on either position. We're going to evaluate if now is the right time for one of those income methods, with, of course, my knowledge of the blueprint and what my fears are, or my expectations, I should say. I don't have fear right now. I have expectations, negative or positive, but that's what we're going to do. So let me go ahead and pause our screen. I'm going to navigate over to the Power Options suite of tools, and I might change screens in a second. I think we'll leave it here for now. So I'm going to go ahead. There we go. Let me make sure the view is changed. All right. So here I am looking at my account on Power Options. We see the market sentiment triggered to a very bullish buy, but that's not specifically what we're seeing. Let me refresh the page here. Using the watch list, my quick view, I can see exactly where we kind of stand. Here's NRG. I had mentioned it's down to 38.91. Let me get a better form of enlightenment there. NRG, 38.91, down 2.9% today alone. SBUX position is down to 62.72 at 135, 2% today. We see what the rest of the market's doing, and VIX calls, or VIX, I'm sorry, is up as well, meaning my VIX calls are up. But that's not irrelevant. That's not relevant right now. So when I'm tracking a married put, really any position I trade in my portfolio, I'm going to add it in Power Options. I'm going to go to My Portfolio. I'm going to click on the Portfolio Tools. Here's the positions that are entered for the radioactive trades. Ignore this one here. That was done during a webinar. Canada Goose has been closed. Ollie's is going to be closed soon, and Planet Fitness was from our webinar the other day as well. Now, we have NRG and SBUX. Real quick, just looking at this basic view, NRG is down 6%, 247 in the past 2 days. Not pleasant, but I've got the proper structure, so I've countered a lot of that with the properly structured puts. Even though NRG is down 6%, we're only down 107 or 2.2%. Looking at SBUX, just the numbers, it's down 6.8%, down 454 in the last 30 days. Not a great trade. Hasn't been a great market. But again, proper structure, I'm not at the full loss. We're also only at a loss of 2.8% on this position. We're holding January puts for both. Now, I'm not necessarily going to overreact with NRG. I knew that the Fed report was coming out. I knew what could happen, but hey, I promised you guys a trade on Tuesday, and I made it. Based on my stock selection and my confidence in this technique that even if we have a continued down market for the next 15 days or into the first part of 2019, I know I've got the proper structure where even if it continues down, I can still make adjustments. I'm only 2 days in the trade. What else don't I have? With the proper structure, I don't have any panic. Yes, the stock's down 6%. I'm only down $100, or about 2% of what I invested in the position, less than 1% of my total portfolio value. I can stomach that and continue to move on going forward, even if I decided to liquidate right now. First things first, let's take a look at SBUX. And when I want to analyze a position completely in Power Options, I'm going to enter it into the portfolio as a linked trade. You see everything here is a linked trade other than that long put on UXIN. Unlike your broker that might just be tracking, you have 200 shares of long stock, 2 puts, you sold 2 calls, but it's not showing it as a collar. It's not showing it as a married put. Here I have everything as a linked trade when entered properly. So I'm going to go to the Position Actions menu and Position Analysis. You can only access this tool if you've put it into the portfolio. Why am I going to this tool? Well, other than the fact that Adobe goes on and off every now and then, this is giving me a breakdown, quick view of my entire position. See, my original stock price 30 days ago of 67.22. We had purchased the January 70 put for 790. My break even at the time is 75.12. But what do we know about that break even? That's only at January 2020 if I hold the position all the way to expiration and make no adjustments. Right now, I'm only losing 2.8%. Not happy about that, but I'm not pressured. I wasn't pressured to do an adjustment. I was going to wait for today to show you potentially live what I might do. We paid $7.90 for that put. It's currently at $10.30. So yes, we've lost more on the stock, but we're hedging that with the proper structure. As we saw on the portfolio, the position analysis view now gives me a breakdown of what is my liquidation. Well, it's about 2.7% after 30 days. Not favorable. In that first 20 to 30 days, the stock has not gone up. So this would be 7 out of 9 trades from what we showed on Tuesday over the past 12 months that have met my expectations. This one did not with Sony. I just stopped trading stocks that start with an S, I guess. All right. Now, my future expiration, the max loss is 6.8%. If what? If I continue to hold it, the stock stays at the price where it is or below 70, I accept no dividends if Starbucks pays a dividend, and I do no adjustments. But as I'm looking at this position, further below, I see some potential rollout opportunities based on the rules in the blueprint. Here we see that with the stock down, I could consider selling my put and buying a lower strike put. It's one of the income methods, income method number 9. Now this usually increases the risk if I kept the same expiration. So in this case, if I just rolled down now to, let's say, the January 65 put, I'm going to get that 1090 back. It's going to cost me $745 to buy the 65 put. Now my risk goes up to 10%. I am going to lower my cost basis down to $72.27. I'm still only going to have 55 cents risk per month on this position, but I'll be holding a 65 put with a lower break even, a lower cost basis, potential further profits or higher profits if the stock does recover, and still keeping a minimal risk on the position. But I don't like that. I don't want to go to 10%. It is an income method. There are rules for when I would do it this way. But there's some other opportunities here as well. I'm carrying a risk right now of 6.8% in the worst case scenario with a cost basis of $75.12. I could make an adjustment right now with the stock trading at 63.63 where I'm going to lower my cost basis to 69.62. How am I going to do that? I'm going to roll down and strike to closer to where the stock is now. I'm going to pay $480 for an April 65 put, but remember, I'm getting about $10.90 back. $10.30 now, but about $10.30 back. So that's going to lower my cost base. I'm going to get $10.30 out of the $75.12, which already includes the original put price. I'm going to take some of that $10.30 and buy a put for $480, and that's going to reduce my cost to $69.62, and the risk is the same. It's at 6.6%. I lowered it just a little bit, but instead of holding a 70 put that's deep in the money, I'm holding a 65 put. Now, on Tuesday, before the last 2 days of decline, I could have actually done this by rolling down to the April 70 put when the stock was still around 65, and it would have cut the risk down to 3%, from 6.8 to 3%. We've had a little bit more decline. So why am I favoring this potential position? Maybe even the July 67.5. That's not bad either, is it? That keeps my new risk at 6.5%. That's favorable as well, and I still have a 67.5 put. Only lowers my cost basis to 72.02 though, 72.22. But it's still 211 days out. This is still 119 days out. I'm debating. In my mind, what am I debating? I'm debating right now if I want to keep within this range or use the April 67.5 with the stock at around 62.70 at this point to lower the risk. I can lower the risk even though the stock is down and hold the April 67.5 put, or if I want to get the lower break even and still keep the same risk. I think I want the lower break even. And the reason why is that if I think the market is going to recover, if I think this is going to wash out a little bit, and I roll down to the 65 put here, generating almost $6 of profit, $6 of lower cost basis. Is it really profit? Well, I've profited on the put. I'm going to use some of that profit to fund this closer in time lower strike put. And why am I able to do that right now? Because I initially structured it properly by going out to January 2020, which allows me to manipulate it in different directions because time is still on my side. Now I'm going to shorten the time frame here, but I'm going to do it to lower the break even and slightly lower the maximum risk. It's great to see things numerically. One of the other power of the PowerOptions Portfolio tools is now that I'm on the position analysis and I see the potential rollout opportunities, I'm going to click on Simulate Trade. What does this do? This gives me a side-by-side comparison. On the left in red is where I initially started out on my position. We know that we're at a loss of about 2.9%, max risk of 6.8%, still have infinite upside profit potential. I can lower this strike closer to the current stock price. Why is that important? I'll show you in a minute. By taking advantage of the gain I do have in the put, use that second asset, not just as insurance that sits there and I've paid for, but use that second asset in my favor to help fund a new put, to lower my costs in the position, still have a reasonable guaranteed exit and a reasonable controlled risk. I didn't lower it by that much, but it does lower it. It leaves the upside open and it takes my break even, again, that's all the way out to January, but from 75.12 to 69.57. And if the market recovers, by the way, what does that also mean? It means I'll start hitting a profit faster. If the stock goes back up to 67, where it was, 65, 66, 67, I'm going to be hitting a profit faster. Both of these are at expiration. But you see here how the break-even is much different. And because time is still on my side, break-even might actually be at around 65, 64.30 within the next 20 to 30 days. Now, there are rules for this income method as well. This is the correct rules, which is why it showed up on the tools there, because we programmed in those rules to help PowerOptions users and RadioActive traders with their management to be able to see the side-by-side comparison, see the ideas, and have the math done for us. So, here we are. Potential to lower the initial at risk, still have insurance out another 4 months from now, lower the risk a little bit, but greatly reduce that break even. Okay, so what am I going to do? I think I'm going to do it. This is income method number 9. I rarely show it, but we're in market conditions where this works in my favor. I am going to put in an order to sell to close my January 70 put, shows me a price of 10.45, and buy the April 65 at 4.90. Now, that's what I'm going to do, but there's something here. I don't know if I want to do it exactly that way. I want to check something first. All right, I'm going to go back to the portfolio. I'm going to navigate back over there. I want to check out the important dates first. So I'm going to click the important dates tab here next to the Greeks view. And on SBUX right now, estimated earnings, it's not confirmed yet, but estimated earnings is around January 24th. Why am I looking at this? Well, if I'm concerned, I could actually roll in closer. I could roll into potentially February, still be protected through earnings, and potentially lower that risk further. Although the portfolio tools showed me the income methods that follow the rules in the blueprint, and I'm really fond of rolling down to this April 65, I'm going to check something real quick. I'm going to go to just the profit and loss chart and run a scenario that did not appear there but is intriguing to me. Income method number 9, that's what we're talking about, rolling the put down, but this is with a sort of income method number 3 shift. I'm rolling down and closer in time. I'm taking advantage of the gain I have in the put to lower the total cost basis of the nested trade. I wanted to come here anyway because right now the 70 puts at 1050 to 1065. Okay, that's good. So my midpoint's probably going to be a reasonable assumption is I could get 1055 for this. I'm going to go with that. Standard February expiration, February 15th, only 57 days away. We were talking about the April 65 put. It's not much difference. I could get about an extra 30 or 40 cents here. This might only cost me $4.30. The April 65, okay, so it's about an extra 50 cents. Okay, so let me take a look here. Here's what I want to do. First things first, we know I bought stock at 67.22, bought the January 70 put for $7.90. I'm going to go ahead and sell my January 70 put. I'm going to assume 1055 as a reasonable price at my broker. That's going to be my target. Jotting this down, 1055. What does that do to my position as a whole? Well, now, essentially, I'm holding shares of stock of Starbucks at 64.57. They're trading at 62.39. It's about a $2 loss, that 2.8% we saw in the liquidation value. So let me take those two out. We know how that would affect us. We get that credit of about $2.60. And that would lower my cost basis down to 64.57. We already saw the April put. I'm just curious. What if I rolled down to the February 65? At midpoint. Reasonable midpoint? Yeah, 425. That's reasonable. Okay. This takes me down to 5.6%. I know I'm giving you a lot here, but this is sort of the analysis I like to go through because in my mind I know what the blueprint teaches me, and there's a trade-off here I don't think I'm comfortable with. The April put, rolling to the April put, lowered our cost basis to 69.57 or so. Here we're at 68.82. That's lower cost basis. The risk is lower at only 5.6% as opposed to 6.6% for April, a 1% difference. February is only about 62, 63 days out in time. April's 119. Yeah, 57 days, excuse me, versus 119. So I am double the time if I move into April for only a 1% increase in risk. That's why it came up in the results. That's why in those rollout opportunities we just showed in the position analysis view, I didn't see a February because it's a little bit too close. And the benefit, sure, it's a lower risk of 5.6%, but double the time for only a 1% extra risk rolling down to the 65. Matches the rules in the blueprint, matches my expectations. It keeps me just about at the same risk, a little bit less. At midpoint, if I get 490, now with the trade-off of already lowering here, if I can still get 1055 for that January put, I'm at 6.4%. Lowered my risk just a little bit, but now I'm holding a 65 put, lower break even. And we know earnings are coming up at the end of January, so I don't have to worry about a sudden spike one direction or the other, except for what the market does, which means what? Well, I've already done one income method. What if I sold that 65 call now? Now that I've lowered my put strike price to 65, and I get 75 cents for it. What does that do to the position? Is that going to put me in a better position here? Let's take a look. All right, 78 cents at midpoint. I'm going to assume 75. Drops, no. No, this is a no-no. Okay. This we see the power of graphing the position. before we just say, hey, I can get another 75, 77 cents to lower that risk further. This is not a favorable position. Negative the entire way. If I wait and I'm right and the stock does recover and we move back up to 63, 64, 65, I can then sell the 65 call for a better price or the 67.5 and get a much better risk-reward profile that doesn't have two ways to lose, or in this case, all ways to lose. So it was an idea. It was a thought to combine income methods, but this doesn't work for me. Yes, if it goes right to 65, I'm only at a loss of about $80. And the call could expire, and I'd have my risk down to 5.4%. But what did I talk about with the CEGA model? The conditions, the market's down, a reaction to the Fed announcement. The market's been down and choppy for all of December. Hey, for all of 3 months, and that's 90 days. But here's a way to lower my cost basis into the position by rolling down with the put, income method number 9, and moving it in with a 3 skew. So my conditions are, stock hasn't met my expectation in the first 30 days. It's down about 6.8%. I feel that with a recent event, that the market may stabilize and recover. So what do I want to do? I want to lower my cost basis, be able to put myself in a position of better profit to the upside. I still keep a long-term put in place through the next earnings event. I still have a low risk. It was at 6.6%. But now is not the time, in my opinion, to combine income methods because I don't like an all ways to lose trade. And if it does recover quickly and it goes back to 67, I'm worse off with this adjustment than if I just leave the new adjustment in place. So very quickly, bear with me 1 second. Let's go back to this. And I just want to look at these numbers again very quickly. I'm going to put in my order with my broker. As the stock is fluctuating in price real time, I'm going to sell to close. All right, we're at 1060 now. I'm going to sell to close the 70 put. I'm going to put in an order, my apologies, to sell to close my January 70 put at 1060. An increase of $2.70 from where I originally purchased it. And I'm going to put this in as a roll. So it's going to be one commission of rolling. Sell to close the 70, buy to open the April 65 at 490 right now, still in real time. So I'm going to lower my cost basis by $5.70 with that transaction. And it's going to be a little different here, but it's going to be a risk of 6.4% if it fills, still with 120 days of insurance, now with a cost basis of $69.47 as opposed to $75.12. And if the market does recover, starts to move back up after the reaction from yesterday and today's reaction to yesterday's events, maybe it takes a week, maybe it takes 2 weeks, maybe it takes into January, or maybe it keeps falling, but you know what? I've kept the same risk. If it keeps falling, I still have other management I can continue to do if the market keeps declining, but if it recovers, I'm in a much better position. Even though the stock is down, I'm going to better the SBUX position with this adjustment. I'm not going to combine income methods right now because I don't think it's the time. We're going to wait to see how the market recovers after this adjustment. All right, so I'm going to do that. That's the order I'm putting in. I know I didn't really cover it well, but I'm going to put that in, and when it gets filled, I'm going to tell my Fusion subscribers. They're going to see the post for the SBUX adjustment, and that's the adjustment I'm going to make today. Although, let's go back here, NRG is down. Although NRG is down further, it's down to 6.4% now. SBUX is down 7.2%. But although this is down 6.4%, I'm countering it. In 2 days, my liquidation loss is only 2.3, 2.7, $128. I'm okay with that. I don't want to overreact just yet. I want to wait and see what NRG does. I'll take a look at the stock chart. I'll take a look at its events. If the market continues down, I'll react. If the market moves back up, I can react as well. But now I don't think it's the time because we're only 2 days in. I'd like to have shown you an income method. I'd like to have shown you a good income method on the one we just opened. Now is not the time. I don't know if you agree that what I'm going to do with SBUX is a good income method. But it's one that matches my conditions, what I feel are the conditions in the market, my expectations going forward. I do expect Starbucks in the market to recover, so I've taken my cost basis down by $5.70 with this adjustment. I'm still protected 120 days out in time, 4 months out in time. I could potentially do this adjustment again, even if Starbucks stagnates and roll into the February, and at that point, I might take the risk down even further, maybe only by 1% or so, but I'm still taking the risk down and still putting myself in a position to do adjustments. February is too close. 57 days with a 5.6% risk, that's not enough time unless there's a major recovery to do what I want to do. I'm sticking with the April. I'm going to put that order in, and when it gets filled, we'll show it to our Fusion subscribers. All right, now, as I mentioned, I don't know what I just did. I know what I did. I had an idea of the income method I might have used on Starbucks. And it's the one I talked about briefly on Tuesday that actually would have cut the risk in half. But because the stock fell a little bit more, we still get the benefit of lower risk and a great benefit of reducing the cost basis, even though the stock is down 6% from where I opened it. More than that. It's almost 7% down from where I opened it. But I put these slides together before we went on to Power Options. What I do know is I evaluated the current situation with the proper tools. I checked to make sure when the earnings were. Yes, earlier today I checked the stock chart to look at my triggers and my indicators as well. So I quickly analyzed the chart. We didn't walk through that today because we're already at 12:56, but we did cover that yesterday. The same criteria, on Tuesday, the same criteria I used for stock selection, the same criteria I used to help me gauge whether to use an income method or not, as well, as I'm not doing with NRG. I made an adjustment based on the CEGA model for my stock and my position to improve Starbucks, but we didn't do NRG, and all of the math was done for me. All the calculations on the powerful portfolio tools were done for me. I could see my new risk right away. I could see the side-by-side comparison of this adjustment, so I knew exactly what I was getting into before I even considered doing it. And that's the power of the income methods, and that's why there are 12. You actually saw income method number 13 today. If nothing looks good, or it's too soon, then do nothing. Wait for a better opportunity. That's what I'm doing on NRG. It's the 13th income method. A lot of webinars, I know many of you have been to webinars. You've seen what I've done before with just selling the call, and we showed not how to do that today. You've seen us do these sort of riskless spread trades. You've seen me manipulate the put in different directions as the stock moves up. But why are there 12? Because there's different markets. There's different conditions, and the different markets and the different conditions call for different actions. Not just selling a call, and if the stock falls, buy to close that call and sell another lower one that you risk getting you assigned. Not simply rolling down the entire bull put spread, not being able to recover the loss you took because the stock went down, and then still having to manage that new spread again because the stock's continuing down. There are do's and don'ts to all the 12 income methods, and we covered a lot of it today. In a sense, the umbrella of it, the do's and don'ts. Make sure it matches your expectations, your CEGA model for the position. Don't force a trade where you're going to add to risk in one direction where you think the stock was initially going to go, or put you in a place with 2 break-evens. Of course, we talked about combining in income methods, but that wasn't there today. Okay? We did not see a good opportunity to combine those income methods. So real quick, I just want to discuss this now. So what do you think about having 12 and potentially really 13 ways to manage a position, whether the stock moves up as you expected, your position stagnates, or it moves down against you, but still having the opportunity to be able to reduce the risk as well? John brought in a comment. The Tuesday NRG trade was only published for Fusion subscribers. That's right. Any radioactive trade I do is posted on Fusion for the Fusion subscribers, those that are following those trades and more. Okay. If you saw the webinar or if you saw the recording when I posted it, you could have seen what I did there. I don't publish the radioactive trades on PowerOptions. Okay. The only place Ernie and I publish the actual trades we're making and the income methods we're doing, John, is on the Fusion subscription. And that's the only place they're actively posted. Okay, so again, sorry, what do you think of the 12 ways? Do you think it's a good idea? It's an okay idea, but how do I know how to use them? Do you feel that having 12 different ways to adjust an already protected position seems complicated? Didn't really show one today, but we talked about that bear call spread. We showed the bull put doesn't follow the income method rules, but a bear call will. So you like the idea of spreads that don't add to the initial at risk. Do you think it's great to have 12 because you've only been using one management technique with your spreads, with your covered calls, or with the naked puts? Or do you think it's awesome that you like the idea of being able to adjust multiple ways in different market conditions? All right. So I've had the poll open for almost a minute and a half. Let me go ahead and, oh, some more votes are coming in. I'll leave it open for a little bit longer. Excuse me. All right, so let's go ahead and close the poll. I'm going to share the results with everyone here that came in. 40% of you say, okay, but how do I know how to use them? All 12 income methods are described in the blueprint in detail. The CEGA model for each income method, when and how to use it, how not to use it to avoid getting yourself into trouble, as we saw that potential income method number 1 position, if NRG did meet my expectations. We're using an improper income method. Each income method has its own chapter in the blueprint. So that's how you know how to use them. 20% of you said it seems overly complicated. Okay, I can see that, and I can see how it could be overly complicated as well. That's why, number 1, we discuss the full details of each of the income methods in the blueprint for you, explained as you just have knowledge of stock trading, that you're not an advanced options trader. That's why we also offer the Power Options tools that we saw today. So once you plug in your position, you'll be able to go to that analysis screen and see rollout opportunities that match the rules, where the math is done for you, and you can see a side-by-side graphical comparison as well as the numeric calculations to make sure it matches your needs. And to be honest with you, there are 12 different income methods. There's a couple I rarely use. Income method number 8. Income method number 11 is a broken wing butterfly. I rarely use that. It has its benefits, and it can be used, and I've used it effectively. But it's not something that I frequently use. I find myself in a pattern of using maybe only 4 or 5 different adjustments, with sometimes, as we saw today, taking that idea of lowering my cost basis with income method number 9 and then shortening the time frame to still keep the same risk I have. So that was sort of combining income methods in a sense, but it put me in the better structure, and the tools guided me to which one was the best. Okay, I didn't really show a riskless spread trade, so no one says I like the idea of spreads that don't add risk. You'll see some of that coming up soon as well. No one said great, that they've only been using one management, and 40% said awesome, I like the idea of adjusting in different markets. And for the 20% of you that said, you know, side note on that, it seems overly complicated, we addressed that, but here's another thought. Right now, the market is overcomplicated as well. You can sit on the sidelines, and I won't find fault in that. You can sit there continuing to hold your stocks, hoping things are going to recover or maybe average down, but if they continue down, you're still taking on a larger risk. I want to protect my positions from the start to have a known risk and a controlled risk. Yes, a bull put credit spread gives you a known risk, but with this kind of market, you find yourself in an 80%, 90% loss, where it's too far gone now to really do any effective management on the position. You had a known risk, but if you didn't apply proper position sizing to a diagonal spread, a bull put spread, any vertical spread, you're finding yourself taking 8-to-1 to 10-to-1 losses, wiping out 8 previous gains, and now in a position where it's too far gone to manage unless you go out 7 or 8 months to try to get a credit and increase the strike prices, which doubles the risk going forward. That's not how I want to approach trading, and this is why it puts time on my side in the proper structure. Okay, all right, so moving on. That's what we're referring to as the CEGA model. That's what's available in the blueprint. Not only the initial structure, the stock selection ideas, and what I used that was shown on Tuesday, but the hows, the whens, and whys to use each of the 12 different income methods properly, and even the 13th as well. A lot of times I have a customer watch a webinar and say, oh, okay, I get it now. That's how I would roll up the put. That's how I would do this bear call spread. And 2 weeks later, they call up and say, hey, I did this income method against the stock position that I had. I don't own the blueprint, but something's wrong and I'm losing money. It's because it was done incorrectly. And you don't have the ideas of how to manage the income methods once it's there. And that's okay. That's why I'm here, is to help traders one way or the other. But just going off from the webinar and starting to apply these techniques yourself, might get you into trouble sooner than you think and might put you in the wrong position based on your initial CEGA model, and that's not what I want to see. I want you to have all of the information available to you to do it correctly, to start off with the properly controlled risk, and in different markets, whether it moves up as you expect, it stagnates, or it falls because of market events that we can't control, still being able to manipulate the insurance as a second asset or do other adjustments properly without putting yourself in a worse position. And again, that's what's available in the blueprint. That's where you can see how to do all the 12 income methods and the proper structure as well. And right now is the best time to get the blueprint and the full story. Head on over to radioactivetrading.com/EOY, end of year. I'll send that link here in the chat link to everyone. The blueprint, if you pick it up before December 31st at midnight, you're going to get these 7 bonuses. One of them is you get your first 2 months of Fusion when you're ready. You don't have to start it right away. If you pick up the blueprint, we'll send you the blueprint. It's a full work contained in a 3-ring binder. We'll send that to you. You can go through it, and then when you're ready, activate those first 2 months of Fusion for only $10 per month. So you can follow our trades, see the Fusion members only webinars, as well as the Blueprint owners only webinars that we have on the site. But you can also look at our track records, follow the trades, see other lessons to help you master the radioactive trading techniques. 60 days for only $20. We're going to send you one of our Mastery Series videos, one of the 6 Mastery Series videos for free if you pick it up before December 31st. You're also going to get 1 month of Power Options for free. If you're already on a trial or using Power Options, that 30 days is just added to your account automatically. So you'll be able to use the portfolio tools. You'll be able to track the positions and use that position analysis view to see the rollout opportunities and more. We'll also send you a quick start guide to help you get started right away with your feet running, for lack of a better term. We're going to send you another video link with a compilation of our most requested webinar replays for radioactive trades. Any Blueprint owner gets call and email support for free. Call us up with questions about the techniques, questions about the trades that we posted, questions about the track record, questions about income methods you're considering. You get phone and email support for free. You also get free shipping. So now, between now and December 31st, it's usually $11 shipping inside the US or $76 internationally. So we're wiping that off the table. You don't have to worry about the shipping costs. We'll take care of that. And in addition to all of that, the Blueprint does come with a money-back guarantee. You pick it up before this promotion ends, you get these 7 bonuses. You start going through the Blueprint, but you still feel it's not quite what you want for your portfolio. You know what? Send it back to me. No problem. We'll refund your purchase price, no questions asked. And you can even keep the free month of Power Options to test out other strategies, search for positions in our patented search tools, and use the portfolio as well. No hard feelings. So this offer does end. Let me just type this out. I forgot to do that. RadioactiveTrading.com/EOY. There you go. This offer does end December 31st at midnight. So you want to make sure you take advantage of that. Pick up your Blueprint before the offer ends. Get your 7 bonuses, but most importantly, get the full manual on how to properly structure your trades in this market. Known risk going in and a known single-digit risk, unlike a known risk on a bull put or vertical spread, which still might wipe out 10 previous gains. If I have a married put and I decided to close it, if I decided to liquidate NRG now for a 2.7% loss, roughly, You know what I need to get back to break even with a 2.7% loss on what I have remaining? 2.9%. If I take a 5% loss, I only need a 5.3% gain to get back to break even. But if you're in a spread trade with these turbulent markets and it goes against you for 80 to 90% of the maximum loss, you just wiped out 8 or 9 previous trades. You're going to need 8 or 9 successes to get back to break even. It's a slippery slope, and that's what's known as gambler's ruin, which we avoid with the proper structure and proper position sizing that we're forced into with this trade. So again, I'm sure you're going to have questions. This webinar was recorded. I'm going to get it posted to you, and I'll send you an email when the archive is available for you to review. But if you have questions, remember you can send me an email at any time to support@radioactivetrading.com. You can also call me during market hours at 302-992-7971. But again, most questions are going to be answered for you in the blueprint, and it does come with a money-back guarantee. And Bhupinder sends a question, how long is the blueprint guarantee valid for? We're not really strict about it, honestly. We'd prefer to see it in 30 days. Okay, if in the first month or so you feel it's not for you, send it back to us, we'll refund your money. 2 months, we're not really strict about it. To be honest with you, I don't have a hard set guideline that you have to meet it by. I'd say 30 days is going to be a good gauge. Okay, if you start going through it and you feel it's not for you, you go through a few more chapters, you're still not confident, call me up once or twice, send me an email, we'll talk about it. But then if you're still not confident, send it back to me. You'll know once you get it and start going through it. The return rate is less than about 2%, to be honest with you. But yes, it's available. It is a money-back guarantee. No questions asked. We'd prefer it to be within 30 days, but it's not a hard line. It's the best way I can answer that. Doug asks, is the portfolio tools and side-by-side comparison available to all PowerOptions users? Yes, and for all strategies, actually. Okay, so if you're tracking covered calls, you can follow the same steps and see the rollout opportunities and the side-by-side comparison. We also have rollout opportunities for other things as well. Credit spreads, debit spreads, long calls, naked puts, for example. So you can use that position analysis screen to evaluate as well. All right, well, ladies and gentlemen, I think that's the end of the questions. I've gone a little bit over today. I hope you all got some useful information out of today's presentation. And remember, before the end, midnight, December 31st, swing on over to radioactivetrading.com/EOY. Check out some more detailed information, but pick up your blueprint, get the 7 bonuses before the offer ends. And I'll let you know when today's presentation is archived. You can check it out. Let me go see how the market is and put that trade in for Starbucks and post it for the Fusion subscribers. And ladies and gentlemen, I hope to see you soon. Please send me any of your questions you have at any time. Take care, everyone. Good night.